Hi, Todd VanDenburg here with VanDenburg Capital Management and another Uncommon Sense update. So since my last update, the markets have pretty much gone straight up. There have been some times with, pretty intense volatility. The meme stocks, Robinhood, all that kind of stuff, caused quite a bit of turmoil. But, generally the markets right now are sitting, pretty close to their all-time highs. And as we get any reasonable, good economic data out, they tend to push those highs up a little bit and then settle back in. And so, that sort of is where that is. But with the markets at the levels that they're at, there's some concern that maybe they're overvalued, given that there's this new Delta variant, and there's talk about adding additional restrictions back in place, and so I want to talk a little bit about that and really what the strength or position of our economy is right now. So again, as you can imagine, right, during the heat of the pandemic, mostly last year, you had jobs that just disappeared. You had businesses that disappeared. So the economy's ability to to generate positive goods and services was really inhibited greatly. And there's some new data out today, the ISM non-manufacturing index, which basically talks about the service sector. And any reading over 50 means that we're expanding. And so what I want to show is a quick chart that shows, just a short time period, well enough before the pandemic. But as you can see in this chart, we are now with an index rating that's substantially higher than pre-pandemic. And the reason for that is, we have a lot of jobs and a lot of economic activity occurring in the service sector to make up for what was lost during that big dip during last year. And so this is a leading indicator that lets us see that the economy is trying to get back to sort of a pre-pandemic normal, but it's trying to get back while trying to make up for some of the lost activity from last year. Now, one of the other things that has people, concerned is that inflation has, been on the rise most recently, in the 5-ish% range, and that's not good, right? And we've talked about in prior updates that the reason for that is, well, when the service sector and the manufacturing sector shut down for almost a year, once people start to get back to work, there's going to be a lag. So there'll be people with money, but there's a lag with the ability to spend that money on goods and services. There aren't enough goods and services, so you have this, supply and demand imbalance that shows too much money chasing, too few goods and services. So again, this service sector index shows us that we are seeing a really positive trend back to recover some of that lost activity. And hopefully over time, that will sort of normalize inflation. Now, on inflation, I want to show something I don't think I showed this the last time I talked about it, but there's a thing called the M2 money supply. And what that shows us is, the amount of currency that's out in circulation in savings accounts, checking accounts, money that people can spend. And as you look at this line on the M2 chart, you'll see that the growth rate is really pretty steady. I mean, I only go back to 2000 in this chart, but this line is just a real nice steady slope. But something happened during the pandemic, and you can see here at the very end of the chart where it spikes. So the amount of currency in circulation spiked, through the pandemic. And a lot of that is, the government, sending stimulus checks and trying to insert cash into the economy, as well as the Federal Reserve doing something similar. So we have all of this cash sitting in the economy. And so by definition, we have too much money chasing too few products and services. And again, that's another reason why the inflation rate has ticked up. So the real question, and there's no real way to know what the answer is at this time, but the real question is, how long is it going to take the economy to basically consume all this extra cash that has been inserted, into the economy over the last year? And we really don't know. I mean, this ISM non-manufacturing index data says that it's trying. So if we continue to see these kinds of spikes in both manufacturing and service sector indexes, then the inflation rate shouldn't remain high for too long, because again, we'll have an increased amount of product and services chasing those dollars, and so the inflation rate comes down. So we don't know when this is going to happen, but what has to happen is one of two things is going to happen. Either the money's got to come out of circulation to keep inflation down, or products and services need to be more available so that we don't have this incredible imbalance between the amount of cash available and the availability of products and services. So again, this index data that I showed you earlier, gives us some pretty positive indication that the economy, left to its own devices, is trying to consume those dollars. And in a free market capitalistic society, hey, if there's an abundance of cash, somebody's going to want to create a business that's going to consume that cash. Idle cash does nobody really any good. So the long story short here is that we're pretty happy about the non-manufacturing index data. There will be some additional index data that comes out on manufacturing. We expect that to also show a spike, which again will lead us to even more potential, positive economic activity in the future. So we're not overly concerned. I mean, it's sort of a shame that the Delta variant is, rearing its ugly head and causing different places to add additional restrictions and talk of lockdowns and things like that. But this too shall pass. If the pandemic has taught us anything, it's that we the people and the economy of the United States that are incredibly resilient, and where there's a will, there is a way, and the data continues to tell us that, and that's why the markets are where they are right now. They're reacting to all of this extra money that's in the economy and the expectation that it will be used to buy goods and services. So a lot of information covered there, but it's sort of important to understand that there are a few different moving parts, and in order to know whether you should be invested or how much you should be invested, you got to follow all of them. Otherwise, you're just going to make investment decisions based upon some emotion that you might feel as a result of seeing a news report, and that's never a good thing. So if you have any questions about this or any other financial matter, please post a comment to this video, send me an email, send me a private message. I respond to messages pretty quickly. But that was your update. I hope you enjoyed it. If you did, give us a like, give us a share, and I'll be back again soon with another Uncommon Sense update. Thanks for watching. If you'd like to be the first to hear of more Uncommon Sense updates like these, please click the subscribe button below. We'd really appreciate it. Thanks again.